Hello and welcome to this webinar, Small Business Tax Liability Reduction Strategies. I'm your moderator, Jenny Alton from the New York Small Business Development Center Central Office. As your presenters today, we have Orumé Hayes, CPA, CGMA, MST, founder and CEO of Hayes CPA LLC, and Shaneque Downie, IRS enrolled agent. This webinar is brought to you by the PACE Small Business Development Center, which is one of the 20 campus-based centers and many more outreach offices of the New York Small Business Development Center. The NYSBDC is a U.S. Small Business Administration resource partner. Our free advising, education, research, and advocacy services are made possible by funding from the SBA, New York State, and our host campuses. In a moment, I will turn the time over to Andrew Flam, Director of the PACE SBDC, to say a few words before the presentation begins. So you know we are recording today, and we will share links to the recording as well as a PDF copy of the slides in a follow-up email. Attendees are muted and will not be on camera. Your chats will only be visible to me and our presenters. If you have any questions during the presentation, please don't hesitate to type them in the Q&A box as they come up. You can open Zoom's Q&A box from the Q&A button at the bottom of your Zoom window. And we will probably address some questions during the presentation, and we may save some for a Q&A session afterward as well. So please do put those questions as they come to you, and we will address them as we have time. And when you get that follow-up email, you will also be able to reply to it to get in touch with the PACE SBDC. If you have further questions that require more detail, more specific answers, they will be more than happy to assist you. So with that, I will turn the time over to Andrew Flam, Director of the PACE SBDC.
Great. Thanks so much, Jenny, and good afternoon, everyone. Thank you all for joining, which I think this is really a dynamic and obviously a very time-sensitive topic for business owners with tax season coming ahead. So as Jenny mentioned, my name is Andrew Flam. I'm the Regional Director of the Pace University Small Business Development Center, or SBDC, and we provide one-on-one business advisory services as well as a wide range of training programs to small business owners as well as aspiring entrepreneurs here in Manhattan, as well as of January, also in Brooklyn as well. So if you are small business owners or looking to launch a business in Manhattan or Brooklyn, I'll put my contact info in the chat in just a moment, so you can reach us, and a link to how you can be able to go ahead and provide a one-on-one session with one of our team of really terrific business advisors. I'm joined today by one of our team members, Greg Callender, PACE SBDC business advisor, who is our lead advisor on kind of accounting and financial strategies, and I think can be kind of a big advocate and a big supporter for your small business. You know, the work that we do really is really targeted to help business owners and looking at kind of areas where we can kind of help you build and grow and, generate jobs, generate economic investment in the communities that we serve. And we really do that through, as I said, through our free one-on-one business advisory services. Some key areas that we look at in terms of helping support businesses is access to finance, marketing and sales strategies, operational challenges, and accounting and financial procedures, as well as government procurement and business planning. So these are some of the issue areas that we work on a kind of one-on-one basis on each and every day. And again, all of our services are offered at no cost. Today's session is kind of a really good example of collaborations that we've been able to kind of work on over the course of the years. We're delighted and very appreciative of the support and collaborations we've had to date with the New York State Society of CPAs, who've been able to help us connect with a range of volunteer CPAs that have done just amazing work. And today's presenter, Orumé Hayes, is one of them. We've been able to do both sessions such as these, as well as engage in kind of one-on-one clinics that my colleague Greg Callender has managed, to helping small business owners connect with CPAs on a one-on-one basis, helping them get kind of direct and targeted kind of advice on issue areas that they're coming up with. So again, we're very, very happy and grateful for the support of the Society of CPAs over the course of the year. And look forward to today's session. I think you'll find it's going to be really, really engaging, and you'll really get a great deal out of it. And we look forward to continuing to work with you and help you build and grow your small business here in New York State. With that, I'd love to turn the table over to our keynote speaker today, Orumé Hayes, and her colleague Shaneque Downie to lead today's session. And we'll be back for part of the Q&A if we can be helpful there as well. Orumé, I'll turn the floor over to you. Thanks so much again.
Absolutely. Thank you so much, Andrew. Thanks, Jenny, and also you, Greg. Thank you all for inviting us to be with you today to speak about small business tax liability reduction strategies. Like you said, Andrew, this is a great time for us to be talking about what we're discussing. So before we get started, I'm not going to go over my bio. That was a great introduction by Andrew. So you can see a little bit more about myself. I've been a business advisor for a very long time. And this is a repeat. I've been presenting with PACE, with the SBDC for over a year now. And I would like to introduce my Shaneque, if you quickly just give us a brief introduction about yourself.
Sure. Thank you, Andrew. Thank you, Orumé. So I'm Shaneque Downie. I'm Brooklyn-based. I'm an enrolled agent with the IRS. I've been doing tax and accounting for over 15 years. And so I'm pretty versed with small business tax and bookkeeping. And I'm also an IRS enrolled agent, which means I represent taxpayers, both individual and businesses, before the IRS. I'm also a business advisor and a bookkeeping and tax coach. Thank you for having me, and I'm looking forward to discussing the strategies with you today.
Great, thanks a lot for that, Shaneque. So I always like to do an introduction. I always want to get a feel for who's in the room. I know we're not all in one space together. We're not in person, but if you would put in we actually can see the chat box, so I guess we cannot do that. But actually, you could still do that. If you want to just go ahead and put in the chat box, are you in Brooklyn? Right now, I'm in Manhattan. Usually, I'm in my office in Staten Island. If you want to say what city where you're at, what stage are you in your business? So this gives us a little bit of insight into the kind of questions that you might be asking, and something we might want to elaborate a little bit on one thing versus another. And then if you also want to share what you'd like to learn from this webinar, apart from, I know we did put some things in there. So I see some things coming in. Someone's coming in from Manhattan. Growing your working tour business. That's great. Thank you. We've got someone from the house from Chappaqua, New York. This is great. And we have somebody from Allison from St. James, and someone that's a startup business. They want alternatives to QuickBooks. We have somebody else from Brooklyn, somebody else from Watertown. This is a nonprofit business, 2 years in the making, hoping to hire folks soon. That's great. We're going to touch on that. We have another person from Baldwin that's in the early stage of starting an employment consulting business. That's good, as a licensed social worker. Great. Thank you, guys. Thank you for sharing all of that. So a lot of, we see we have a couple of different stages of business. We've got somebody else from Suffolk and Queens as well, someone with a cleaning business. Great. So we'll try and address as much. We'll speak in broad terms and then speak about some industries as well. And if you have particular questions once we get started, you can go ahead and put that in the chat box as well. So our agenda for today, we're going to talk about understanding and managing cash flow. We'll talk about owner's compensation. How should you structure owner's compensation? We'll talk about the different tax structures for different businesses. And then this is a question we always get. What's the difference? What is accrual tax? What is the difference between cash and accrual accounting or tax filing? And then tax depreciation, which is a very lucrative type of tax benefits that businesses can get. And with that, let's get started. So what exactly is cash flow? So you guys might have heard this saying, right, that cash is king. That is correct. So cash is, like it says on there, it's the total amount of money that's coming into your business and going out of your business. Without cash, you cannot effectively run your business, right? You need cash to pay your bills. You need cash to fund your operations. If you have employees, you need cash to fund to pay your employees. No employee is going to work for you with an IOU. They all need to pay their bills. So you need to be able to pay your bills and fund your operation. So it's very important for you to know your cash positions. Yes, you can operate your business on credit. Sometimes you have customers who give you credits and you can pay those bills over time, but you need to be able to operate a cash flow statement and evaluate how much cash do you actually have coming into the business and how much cash do you have going out of the business. Shaneque?
Yes, I couldn't say it better. Basically, positive cash flow is very important because we don't want to operate on IOUs, just like we don't want people to owe us. We don't want to owe our vendors or employees, the IRS, on any other state tax agencies. So today we're going to discuss like strategies that we can use to keep our cash flow positive and fluid.
So what are your sources of money? How do you get money? How do you get cash in? Well, you get cash by selling. You have sales, I have some clients who have had their businesses for, you don't want to be in a permanent state of startup, right? So that where you're constantly investing money in setting up your business and you're actually not selling anything. If you're in that constant state of startup, of setting up your business, the IRS is going to look at you as a hobby. That's another discussion. So you actually need to be able to sell something, whether it's a service that you're providing, you need to get money in, or you're selling a product. So you want cash to come in. Accounts receivable, if your clients don't pay you in time, that's when you have accounts receivable. You want to try and avoid accounts receivable. Don't sell things on credits. Most of the time, it's like you want to go to a restaurant, and when you finish eating the restaurant, and tell your waiter, can you give me a bill, and I need to pay for my my bill in a week or a month or 30 days. You want to avoid stuff like that. If you don't have money to right now operate your business, you can get cash by getting a loan from family or friends or from the bank. And then equity investment. If you have other partners who want to invest in your business, that's another way for you to get cash into the business. Shaneque, do you want to cover the outflows?
Sure. And cash outflows is, money that we spend. So usually those are operating expenses that covers your payroll, your supplies, your rent, advertising, anything that it takes for you to operate your business, as well as your accounts payable. So when you take out supplies or anything on credit, it doesn't affect your cash flow in that moment. It's when you pay it that it affects your cash flow. Loan payments for those proceeds that Orumé discussed, and equity payments, so anything that dividends, distributions to your investors, those all reduce your cash flow, and that's the outflows that we will experience as business owners.
Correct. And the other thing you want to keep in mind is that there's something. So if you look at the first, let me see if I can get my pointer. If you look at the first bullet point there that says cash or cash equivalent, this is the most liquid type of cash. When you actually have cash, when I say cash, I mean paper cash, right? So accounts receivable, this is not liquid. So accounts receivable, it will take you maybe 30 days for you to turn for your client to pay, right? Or 60 days, and some people take longer. So you always want to have cash, either cash in hand or cash in the bank. Cash that you have in the bank is still considered cash. That's just a technical way, the way that we say, but that is still considered cash. All right, so let's go over how do you do this evaluation? So you are operating, you're in business. You want to make sure that you are projecting and you're doing your monthly cash allowance. So what this is that this shows us a monthly, part of a year's monthly cash flow. And we look at the numbers from January, February, and the month of March. So we see here, I just want to explain this to you so that when you do your evaluation, you're able to do this on your own. Our opening balance at the beginning of the year. So this is a business that's, let's say it's the second year of business, right? So they made some money last year and now they have 18,000 in the bank. So for the year, they sold and they collected from their customers $50,000. They sold some services or products that they did not get paid for. So they have 12,000 in accounts receivable. They got money in from the bank, right? So they got a loan, they got 10,000. So the total cash in is $72,000, or rather they collected, this is accounts receivables collection. And so they got total cash in of $72,000. And then when we look at the outflow they spent $45,000 $40,000 on just their operations, rents, bills, telephone expenses, office supplies, and things of that nature. They paid down their accounts payable, right? So that total outflow is $50,000. And then you see what happens each month. We also have the projection. So the next thing we want to do now is find out what was their cash result at the end of the first month of the year. So we see that the monthly balance is 22,000. How did we get that amount of 22,000? It's the amount of cash you brought in, the 72,000 less the amount of cash you spent. So the monthly cash balance is 22,000. And then we see that the cumulative balance is 40,000. How did we get the 40,000? Because you already had 18,000 in hand when you started the operations for the month. And then with what you had at the end of the month, that's how we got to our cumulative balance of 40,000. Shaneque, you want to pick up with February?
Sure.
Yeah, go ahead.
So your cash, we didn't have an opening balance for February because it does just carry over. So the opening balance for February is the ending balance for January. With your cash flow statement, it's continuous. It's not just for that period. So just keep that in mind when you're evaluating your business period over period. So this could be a week over week, a month over month, or a year over year. Similar to January, we had some sales and some accounts receivables, as well as no loans in February. So just 45,000 of cash inflows. However, in February, we picked up a lot of outflow activities because we had 58,000 in operating expenses, more accounts payable, and we started to pay back that loan. So in February, we had a net cash outflow of $70,000. What that does is we spent more than we took in the month of February. However, we're still positive when it comes to our cumulative balance because we had 40,000 to begin with. This is something that we want to keep track of month over month. Like, is our expenses or inflows and outflows, are they relatively the same? And you'll start to develop patterns and you'll learn to read your books because you'll know which months, like we're accountants and tax preparers. So we will have more inflows in this first 3 months than the next 9 months. And so it's different from business to business, but it's important to understand your business cycle and your structure as you read your financial statement.
Yes. That is true. So, and the reason you want to do that is that because so this is a business that's very positive, that's making money, right? But if, for example, in the second month in February, if our beginning cash flow was only $10,000 or only $5,000, we will be a deficit. We would have a deficit because the monthly balance was negative 25,000. What this tells you is that when you do your projection, you're going to see that, hey, I'm going to be down $25,000. So I need to raise $25,000 so I can meet my operations next month. Either I have to go to the bank and borrow $25,000, or I have to make sure I increase my sales instead of what that projection, I have to make sure I increase my sales. So that is why you need to be able to analyze your monthly cash flow. Okay, so now, when we this is a cash flow statement. So there are two different things. There's a cash flow, that is the cash flow projection, that shows you your projection month by month. And then this other report, this is the cash flow statement. This tells you how you're doing when you're doing your analysis. How much cash are you getting from the operations, the operating activities of your business? And then we're going to see how much cash activity is going on with the investing activities of your business. So operating, you guys know that, right? It's like your day in, day out operations of the business. How much are you selling? How much are you using to pay your utilities and all of that stuff? When we talk about investing activities, we're looking at things like fixed assets. What big item tickets are you buying? Are you getting money from investors, or are you buying a new vehicle that you're going to use to transport flowers or for your transportation business. So it's called an investment because you're making a huge purchase. The investment purchases are usually large. It's not like paying a bill. And then financing activities is if you are, borrowing money from the bank or from equity investors. Okay, so you can see here for the operating activities, when we go ahead, and I'm not going to go too technical because I don't want to lose you guys. But when you plug in your numbers and you look at your actual cash that you actually spent, what we see here is that our cash operating activity, we were actually negative 30,000. What this tells us is that even though for the year, you can see that this net income, this business had $25,000 in change in net income. But when we prepare the operating cash flow reports, they were down 30,000. So sometimes you hear businesses complaining, how come I have no money? I have on paper, it says I made a net profit, right? But where's the money? I don't have any money in the bank. I don't have any cash. What's going on? That's because there's some things that are not cash. Maybe you sold a bunch of things and you did not collect cash. So for example, they have a huge accounts receivable, 90,000 that they've not collected. You're giving away credit for free. Somebody else is using your money to operate their own business. They're not paying you back on time. So that's why you want to be able to do this analysis. And then when we look at investing here, Shaneque, you want to speak to this investing activity?
So as Orumé pointed out, like sometimes your operating activities are more than what you're actually collecting. And so that that might open up an opportunity for business owners to indulge in either investing activities or financing activities. And so those are balance sheet activities that help with or balance out your operating cash flow. So with those investing activities, it could be taking on a new partner. So that would be like equity investments. And the financing activities would be your loan investments, your loan or your credit card payments that are there to help you with your cash flow. I'll also point out that I like to describe it as the cash flow statement is how we reconcile the profit and loss with the balance sheet. So as you see, we started out with the net income, and we're going to end with the balance, the cash at the end of the year, which should be your balance on your bank statements.
Right. So that is correct. So when you look at this number, so you can see when you have a negative here, that means it's an outflow. So what that means we're spending money. So this business invested money in maybe purchase a new vehicle or in some equipment for their business. So they spent 16,000, and then they paid back their a loan. They paid back 20,000, but then they also borrowed or somebody invested in them 10,000. So that was a net financing outflow or financing activity of 10,000. When you net all three types of activity together, they had a decrease in cash of $56,000. So you see here at the top, they began the year with 18,000 in the bank. They had net income of 25,000, but guess what? Your cash at the end of the year is what? It's negative. So when you can do this kind of analysis, that tells you that, hey, I need to be aware of this. I need to concentrate, because that's how business is. You know how one day you're walking down Fifth Avenue, Madison Avenue, or someplace in Brooklyn or in Queens, and then the next, a month later, you're walking down the streets, and what do you see? You see the sign out of business. Why does that happen? Because businesses are not keeping track of their cash. They're not doing this analysis on a regular basis.
Orumé,
Okay, so now
before you
Yes.
continue on, we did have a question in the chat that I know Shaneque answered it in the chat, but I would love to have you show it. This person wanted to know about how to account for the owner's initial capital of a business in that type of statement scenario.
So the owner's business would be a finance activity.
Okay.
The owner's initial investment. Is that what you're talking about?
Yes. Yeah. They wanted to know, how would I account for that on my actual statement to show that?
So it's equity. It's owner's contribution. So depending on how the business is structured, and we're going to talk about different tax structures right now. but that would be a financing activity. So this is owner's capital, that it's you investing in a business, and it would go on the balance sheet. Is
Thank
that
you. Yes,
does that
thank
help?
you.
Shanice, do you want to add something to that?
No, that was what I answered. So and by the way, the terms are a little confusing because it is equity investment, but it's actually a financing activity, not an investment activity.
Exactly. Thanks for sharing that. So now we are going to move on to owners' compensation. This is something that a lot of small business owners, they always want to know, how do I get paid? I'm running this business. I'm like, I don't know, when do I get money out of the business? How do I get money out of the business? So you can get paid in a bunch of different ways. It's not just necessarily getting a paycheck. Yes, a paycheck is one way that you can get paid. You can get paid by, you can decide that I want to get paid $50,000 or $100,000. First of all, how do you determine how much you want to, you should, what is a fair compensation? What is a fair amount of salary for you? What you're going to do is figure out if you were hiring somebody else to do that work. So you're a chef. If you were going to hire a chef to come into your restaurant to be the person in the kitchen, how much would you be paying? What is the salary that you'll be paying that chef? That is kind of an equivalent amount that you can use to gauge, to see how much you should pay yourself. And then the other thing, actually, before I go into this, that you should keep in mind, though, is that you want to make sure that the business has the cash to be able to make that owner's compensation. The last thing you want to do is decide that you're going to pay yourself $100,000 or $150,000 and continue to take money out of the business, but that the business cannot sustain itself because it cannot afford to pay you that high salary, even though that's what your work and the service that you do is worth. You know, so you could decide, sometimes businesses do that. You could decide to pay yourself a reasonable low salary on the low end, maybe 40, 50,000. And then you could, at the end of the year, if the business has been profitable, you could give yourself a bonus and or commission based on whatever structure, whatever you decide. And if you have other people going on, there are other things that you can do to increase your total compensation, fringe benefits. So if you have your medical insurance through your company, that would be a benefit that would add to your total gross compensation. The other ways that you can compensate yourself, taking a draw, right? If you're an S corporation, taking a distribution, you can get you could be compensated depending on the business structure with stock options. These are all types of different compensation. And of course, retirement contributions. It's a very, that could make the difference between, let's say, getting 200,000 or 100,000 a year versus 150 for the full year. By the time you add on all of these different elements of compensation, some of them are tax-free, some of them you're deferred. We're talking about retirement contributions, and we'll talk about that later. Shanice, anything else to add on this?
I know you're going to get to it on the following slides, but these all cover different types of compensation, but it depends on the tax structure that you've chosen. So not all of these apply to everyone. So LLCs and sole proprietors don't take a salary, but S corps do. And Orumé is about to get into it.
All right, you can start, and then I'll cover up on the back end.
Okay, so the sole proprietor, as a sole proprietor, you are essentially, you in the business where taxes are concerned aren't separate. That is filed on a Schedule C that goes directly on your 1040. And so an LLC or a sole proprietor, a single member LLC or a sole proprietor does not take a salary. Instead, you take a draw. Essentially, you just transfer the money from the business account to yours. That part is super important because we don't want to commingle. So you just need to transfer X amount of money from the business account directly to your personal account. That, like I said, is taxed on your 1040. So whatever the business earns is what you earn. And because of the informality of it, it's very flexible. Partnerships are taxed similar to LLCs, except it's based on your percentage ownership of the business. So you transfer it directly from the business account to your account. The income or the loss, it doesn't go directly on your 1040. However, you get a K1, but essentially the taxes work the same way as a sole proprietorship or an LLC. With S corporations, however, we need to take a reasonable salary. So S corps, the owners or the shareholders is what they're called, they take a reasonable compensation. So you get a W-2 from the business. Anything above your salary is a distribution or dividends. And then you also report that on a K-1 on your 1040, your personal return. The most
And
complex.
before you go on to the corporation, let me just go over this factor. So you can see down here, these factors are for an S corporation. This is an area that the IRS audits a lot because sometimes a lot of S corporation owners, what they want to do is take out distributions out of the business. So you're just taking money out of the business. When they do that, they avoid paying Social Security taxes. As an S corporation shareholder, you are subject to income tax as well as payroll, Social Security taxes. So they want to take money out as a distribution without taking a salary. But so the IRS says that you have to take a reasonable salary because they're going to look at your business. Your business is making 500,000 a year or 200,000 net income, and you're saying that you're not taking any salary. You've been in business for 3 years. Why are you not taking this reasonable salary? So this is an area that the IRS audits a lot, and they look at all these things when they're auditing S corporations to see what is the salary you're trading, what is the experience level, and these are all these different factors, and you guys can read that at your leisure. Okay, go ahead, Shaneque.
The C corporation is the most complex. You do have to take a salary because the C corporation actually doesn't report to your personal income. This is the only business structure that you don't get a K-1 or anything. So you do have to take a salary. If you do dividends, that one is also reported as a 1099-C. We mentioned here the double taxation, and that's because C corporations they pay their own taxes. The other three don't. Those are passed through entities and they flow through to your personal income where taxes are concerned. But C corps at the moment pay a flat tax of 21% on the federal level. And then there's state taxes, and any distribution that comes out of there is then taxed again on your personal income.
Yes. And I see there was a question in the chat about where does this fall align for a nonprofit? So nonprofits, you would be a nonprofit, the owner of a nonprofit, you would have to be, it's nonprofits a little bit different. So you don't have owner's compensation in nonprofits. If you are an employee of the nonprofits, you will be taking a regular salary. There are laws that you, as a not-for-profit organization, you should not be benefiting from the nonprofit organization. So the nonprofit should not be you should not be paying your personal bills. You should not be benefiting from the nonprofit because it's supposed to be a charitable organization. However, if there are full-time employees, if you are a full-time employee of the non-for-profit, then you will be regarded as a regular employee and you would get a regular W-2 from the nonprofits. Hope that clarifies. All right, so moving on.
We do actually have a few more questions here. Do you want to take them now, or do you want to wait?
Yeah, sure, go ahead.
Okay, so so for commission bonus payment or distribution payment, do you get a lower tax rate compared to pass-through for sole proprietor versus LLC with S corp election? Is what this person wants to know about some of these different entities.
So no, bonus and commissions are considered ordinary income. So they would be taxed just like your salary is taxed.
Okay. So these startup requirements for paying oneself, the requirements for paying oneself, do those apply to within the first year of a business when it's just starting up?
Yes. So if you're a sole proprietor or a partner or multi-member LLC, which is a partnership, then you are still going to pay yourself the owner's distribution, and you report those on your 1040. For an S Corp, you do have to pay yourself a reasonable salary as well. And so as a strategy that I use with my clients, unless there's like a huge amount of money you're expecting in the first year, I don't usually elect S Corp status in the first year. It's a tax strategy, and so it should be, it should be evaluated, it should be quantified and qualified before you move forward with such a step. So once you elect any structure, you are supposed to, from that day forward, be following all the laws and the legalities that go with it.
That is correct. And I'll add to that. Usually the threshold I use that I like to give to clients before converting to an S Corp is usually making at least a minimum of 100,000, because with an S corporation, remember we said it previously that a sole proprietor is the simplest tax structure, and you just simply file on a Schedule C. With an S corporation, you're filing a corporation tax return. It's it's a more complicated tax return. You have more compliance that you need to fulfill every year, things that you have to do. So it's just more, it's more expensive and more cumbersome to maintain that structure. However, the key thing to keep in mind, like we said earlier, cash is king. If the business isn't making any money, whether you are a sole proprietor, or an S corporation, or a partnership, the IRS is not going to audit you. They're not going to fault you for not taking any salary in year one, right? So if you don't have any, if there's no sales or there's no cash from which you can pay yourself.
Okay, that actually answered another question that just popped about whether or not, if you don't have the money to pay the salary, then what happens? So, okay, so if you do need to pay yourself from an S Corp, what is the best way to do that? Would you do like a paycheck with a pay stub, or would you need a payroll system? How would you best handle that?
Yes, so you could set up, there are different ways that you can do that. Some businesses, because their cash flow is not even, the income source is not even, so the decision to set up salary, let's say at 50,000 at the beginning of the year, might not be easy for them to do. So they make that decision on the back end. They'll retroactively run payroll, pay themselves at the end of the year. So in other words, they'll be working for free throughout the year. However, to keep it simple, you can run payroll as a single member. You're talking about an S Corp, right? For us, an S Corp with no employee, you can run payroll because the IRS wants you to take a reasonable salary. What they want you to do is pay into the system so that you pay Social Security. If you're just taking money out of the system, which you can do out of your business, you can take money out of your business. That would be called a distribution, and that is not compensation. So there's a difference, like we said on the previous slides, between compensation and distribution. So with the wages, you have to pay all the taxes. You get a regular paycheck as if you were an employee of your company, and then the distribution, you just take that out as long as you have, the business is making a net profit, and as long as you have investments in the business, that's a tax thing. Anything else?
So
Denise?
Speaking of those distributions, are dividends and distributions taxed then? To clarify on that.
Distributions are not taxed if you have enough, for lack of a better word, I'll just say skin in the game. So let's say my original investment in a business was $5,000. When I want to take a distribution out of the business, I can take $5,000 out of the business without any consequences. Once I exceed the initial amount that I invested in the business, then I have to have something else in the business for it to be everything else that I take out of the business is no longer a distribution. Now it becomes a dividend, and I have to pay tax on that. And then that will clarify. Shaneque, what would you add to that?
Yeah, just to rephrase, your distribution is just your equity in the business. And that's the difference between distribution and dividends. Distribution is up to your equity. Dividends is everything above that. So distributions are not taxed. You're essentially saying, I loaned the business this money and I'm taking it back. And then dividends, they're taxed, and it's just based on your tax rate.
It's a lower tax rate, right? So it's whereas your wages, right? It's your ordinary income. So if you're in the 24%, you're paying a higher tax rate. But a dividend would be at the lower tax rates, which could be either 10 or 15%, right?
Okay. So we have several questions around deciding between these different entities as far as if you are about to set up a business. Are you going to go into that more in what you're covering coming up, or?
No, so let's go, because this, I think the next thing we're going to talk about cash value versus accrual. So if there are more questions on entity selection, let's go ahead and address those, because we might.
Sure. Yeah. So what are your recommendations as far as how someone might best decide between these different types of entities?
Unfortunately,
go ahead, Shaneque.
Unfortunately, that's not a one size fit all. These are all strategies. And so we would say make an appointment and consult with a tax strategist. It depends on where you are. It depends on where you want to go. It depends on where you live even. So these aren't one size fit all. And so I couldn't consciously just give you a recommendation.
Okay.
So that's true. But I would, to add to that, I would say at the most basic level, if you're operating an Airbnb out of your house by default, or you have a lemonade stand, or and you're driving an Uber, by default you are a sole proprietor. So you're not registered. You haven't gone through the formal process of registering a business, registering with the Secretary of State or with the county clerk's office. So you start to sell something or service the public, you are a sole proprietor. If you want to take it to the next level, then you become an LLC, and you can still be a single member LLC. The difference between a sole proprietor that is not registered versus an LLC is that you have limited liability with an LLC. As a sole proprietor, if somebody gets injured while you're providing a service to them, they can sue you and your personal effects. So you have unlimited liability. With the LLC, that gives you some protection. With a partnership, obviously, if you're going into business, you're not going into business alone. You have one or more partners. It has to be at least two people, right? So it's a strategic partnership. You need somebody that can design. You need somebody who's a salesperson for whatever the difference, the reason is. So you cannot do the business yourself. So that's when you would consider a partnership. The S corporation, you want to consider that. Basically, like I said, one of the things that you can look at is if you want your shareholders, there are different things that you're looking at. You cannot have more than 100 shareholders. You cannot have any foreign partners. So if you wanted to have a business, you have family abroad or partners abroad that you would want to be part of your business, the S corporation would not be a good source for you. And the corporation, you're looking at things like if you want to be able to, when you look at a lot of the big corporations in America, that's when you want to be able to sell to the public. You want to be able to have, or rather raise money from the public. You want to have Joe Schmo down the road come invest in your business, right? So how does Apple operate? Apple it's their public corporation. You can buy their stocks in the, so that is what we call capitalization. When you have a business, a lot of startups that they are going to need a lot of external funding down the line. Lots of startups, technical IT in that space, they usually go for a corporation. One thing that you want to look at, so I did mention this section 1202 exclusion. The other benefit about a corporation, if you know you're going to be in a business where you're going to be very profitable, you're going to make money. Sometimes people don't go for a corporation because it's very expensive to maintain and the compliance is a lot. But if you were to do a corporation and you kept that corporation active, you held on to that business for 5 years. If you sold that business or you transition, you exited out of that business after 5 years, guess what? you can save up to, what is the exclusion? I believe up to, is it 5 million or 10 million of exclusion? So if you have make profits in that corporation, then you wouldn't pay any, you wouldn't pay tax on it. So there, like Shaneque said, there are lots of different factors. So it's not a one size fits all. You have to look at what is your goal for that company, what you want to achieve, and how involved do you want to be. So you can see that these three companies have management involved in it. You can hire somebody else to manage it, or you can manage it yourself. So they're just different factors that one needs to consider.
Orumé, I wanted to thank you so much for going through that. And just for the limited amount of time we have left, I'd love to move on, but I did want to make a quick reference to the fact that business entity formation is a very complicated and a very involved process. Orumé did an amazing job in a matter of moments describing it, but we do host sessions on that very topic directly, and we've had kind of a very positive ongoing partnership with the New York City's Bar Association through the Neighborhood Entrepreneur Law Project. So if any of you have questions on that topic specifically, put it in the chat or email us, and we'd be happy to try and help you. But I'd love to get back on track and make sure that Orumé and Shaneque can get through all of their material today.
Right.
Absolutely.
Thanks for that.
Thank you.
Thanks,
I just wanted to say there have been several thanks that have come in that was a very, very helpful explanation. So thank you for
awesome.
that. And we will hold all other questions until later. So go. Thanks.
Okay, great. So accrual versus cash accounting. Most small businesses are going to operate cash accounting. A lot of business, there is no reason for you to be running accrual accounting unless you're right now. Actually, the law recently changed. I believe, what is the threshold, Shaneque? Is it 5 million
Yes,
for
I
small
think
business? Yes. So the difference is that when you get cash, if you're operating, when we say cash, when do you record revenue? When you sell something and somebody pays you in cash, that's what we call cash accounting. Once you get paid in cash, whether it's check or credit card, once you receive that payment at the time the service is rendered, that is cash accounting. For accrual, basically, when you provide the service, so construction places, right? You go and they're building a building in phases. Once they're doing that work, once they complete phase one, they've done the building, they complete phase one, they can bill the client for that. Even though the client hasn't paid, they will accrue their revenue. So they're saying that they've earned 100,000 or 200,000 for whatever the work they did, even though they haven't gotten paid. So that's the main difference. The same thing with expenses. Accrual expenses, you purchase something, whether it's from Office Depot or supplies, or from Home Depot. I mean, Office Depot, well, yeah, business related, but you haven't paid for it, or you've used up those expenses, right? And you haven't paid for it. You're going to pay for it in the future because you have credits with that supplier. On the other hand, for cash, you record your expenses when you actually pay those expenses. You pay your utility bill, you pay your telephone bill. That's where you record it. There is bad debt. So another question that usually comes, like sometimes I get clients who say that, oh, can they deduct a bad debt on their tax return? If you're operating cash accounting, you do not have bad debt. Why? Because you only recognize revenue when you collect cash. You haven't sent a bill to an invoice to a client, and they refuse to pay you. That bad debt is only applicable when you send something to a client, an invoice to a client. You try to collect from them for a year, 2 years, 5 years, and then ultimately you decide that this client is never going to pay, they're going out of business, and that's when you recognize the bad debt. So accrual is complicated, cash is a simple, and I think that so most businesses use cash accounting. Shaneque, do you want to touch on depreciation?
Sure, but I'll add to bad debt, like to simplify it.
Sure.
In accrual-based accounting, you pay your tax based on what you've invoiced. And so you essentially pay for the taxes. Like in 2023, you had some invoices that you sent out and you paid the taxes on them. What bad debt allows us to do is to write those off, like to recover that tax that you paid. So that's essentially how bad debt comes along. So to Orume's point, if you're on cash-based accounting, you don't have bad debt because you didn't pay taxes on it. It becomes bad because you've paid the taxes and then you never got the money for it.
Yeah, and if I may say before you move on, Shanice, another thing with cash revenue. So sometimes you hear folks say that, hey, I got a check from my clients. They paid me for something. Can I wait until next year to deposit it because I don't want to pay the tax this year? So that's one strategy that folks say. So you haven't received, as long as you haven't received the cash. Once you get that check from your customer, you're supposed to recognize that cash. You're supposed to recognize that revenue within the year that you get the cash. But sometimes people defer payment or revenue to another year because they're strategizing because they want to stay within within a low tax bracket. Okay.
So depreciation. Depreciation essentially allows you to write off fixed assets. With expenses, let's say you go out and you buy printer, it's $200. We get to put that directly on the P&L and we get to write it off when we purchase it. However, with fixed assets, and I think the threshold is $2,500 with IRS, you have to capitalize on those. So let's say you go out and you buy a $10,000 printer from HP because you're a printing shop. Those we do not get to expense all at once. And so that's where depreciation allows you to depreciate or recognize that expense over time. The IRS has useful life that they assign to different categories, and that determines how you depreciate an asset. So back to the HP printer, I think it's 5 years. So if you pay $10,000 with straight line depreciation, you can depreciate it $2,000 a year until you get to zero. However, there's bonus depreciation that allows, like, it's an accelerated way to depreciate. So it's still $10,000 with bonus depreciation. As of last year, this will go away, but it used to be you could take 100% in that year. The tax laws have gotten a little bit more complicated and they're going to change that. I think it's 80 this year, 60, and then 40 until we get to a different number. So that sums up what depreciation is.
Right, and so I would say add to that. So depreciation, so it's like an additional expense. So you cannot take all of the deduction. Usually with what we have, this de minimis savable election, you can, if you buy a new laptop and it's under 2,500, you can deduct it all. Sometimes though, it doesn't make sense for you to take all of your deduction, because if the business is not yet profitable, you're not making a lot of sales. You want to use the regular 5 years. So what is the useful life of that asset? Is it 5 years, 7 years? You want to depreciate it along the depreciation useful life instead of taking all of that deduction in year one. I don't think anybody is spending a lot of up to $1 million. If the tax law does allow you to, you could actually, section 179 does allow you to expense up to $1.2 million on an item. So if you were buying an airplane or something, that's something that you could take a deduction on. But again, like I said, you want to make sure you have the revenue to support that depreciation, because otherwise it's not relevant. So this is very timely because somebody just actually, I saw a question coming about QBI in the chat box. So Shaneque, you want to go with this?
With the QBI?
Yes.
So the QBI deduction is something that came about in 2017, the TCJA, and it allows pass-through entities, sole proprietors, partnerships, and S corps to deduct 20% of their business profits directly on their 1040. It's a really great deduction in that you do not have to itemize to get it. As long as you're in any one of those business structures, you are allowed to just take a 20% deduction. So if you made $100,000, that's a 20% write-off. And yes, with S corporations, even if you take a salary, any additional profits from your business is still a QBI deduction. Specified trade or service businesses, that's like us, we're accountants, doctors, and architects. They're essentially professional service businesses. We are not allowed to take it if we make more than, I think, $325,000. It's a little more complicated, but in the simplest form, it's 20% of the business profits that you're allowed to deduct on the first page of your 1040, whether or not you itemize your deductions.
Yeah. And if you have multiple business, this is another strategy that folks do. A lot of people sometimes have multiple businesses. Sometimes it's not in all cases. If one business has a loss, you might be able to aggregate all of your businesses together, so you can get advantage of you can utilize the 20% deduction. Obviously, if a business has a loss, you do not get that QBI deduction. Okay, so let's talk about the independent contractor employee or statutory employee. A lot of businesses sometimes we'd like to use consultants, outsource folks, right? Because we don't want to have them on payroll and pay taxes. So the IRS, this is something that the IRS tends to audit businesses on, and the states as well, because if somebody is working for you and you're telling them what to do, when to come on the clock, when to clock in, how to do their work, you are basically an employee. And so sometimes you might get an audit letter either from the state or from the IRS, because at tax time, the individual says, where's my W-2? Even though you've been giving them a check all this time and you were not taking any taxes, they were very happy to get that check without any taxes. But then come tax time, they're like, why did you take taxes out of my paycheck? Then they might file a complaint against you. So you need to know, are you hiring an independent contractor or an employee? There are different factors that the IRS uses to determine if you are controlling what that employee does. What is the behavior? What is the financial control? There are different things that the IRS uses to look at this stuff. For the statutory employee, this is for where you have an employee who is doing some things, who is working kind of independently, but they are classified as a statutory employees. When the tax law changed with the, what is it called, the CGMA Act, when the tax law changed a couple of years ago, employees can no longer pretty much take any deductions. They tend to take the standard deduction. But if you are a statutory employee, you are permitted to deduct your expenses to file a Schedule C so that you can get some additional deductions. Usually, employees only file a regular 1040 and take the standard deduction.
So just to add to that, the statutory employees is usually only two sets of people. It's insurance workers and real estate. So essentially, if you're working as one of those, you get treated somewhat like an employee, because your employer will pay your FICA taxes for you, which are your Social Security and Medicare. But you also get to file a Schedule C, so you can deduct the expenses like a sole proprietor does. That's what a statutory employee is. And over 15 years, the only two times I've seen it is with real estate employees and insurance employees, insurance salespeople.
So I want to be mindful of the time. I know we're at the top of the hour, so I just went through a bunch of slides. So we skipped a bunch of slides. We didn't really get to talk about retirement. So when we talk about retirement, there are lots of retirement opportunities, contributions, strategies that you can use as a small business owner, where you can take that deduction as a business expense and also save and contribute to the owner's future retirement. So if you are not participating in any retirement program, or if you don't have one in your business, you should consider opening up a retirement program. The regular one that most people do is a traditional IRA. That's where you can deduct, you can contribute up to $6,500. A Roth IRA is really good for folks who are in a low income tax bracket, because what that means is that you pay tax now, and then your money is going to grow tax-free. The limits are there on the screen, $6,500, or then if you're over $50,000. But this is where, for business owner, this is where you can get to save a lot of money. So you can see, yeah, if you have a salary deferral plan, you can save up to $22,000 and change. And if you're over 50, another 7,000. So pretty much you could save $30,000. So you have to, but you, again, like I said, began this discussion at the beginning, you have to have the cash, because you have to, one, pay that money into your retirement account, take that $30,000, but you'll be able to take that the deduction on your tax return, which will reduce your tax liability. So these are all different programs that you can do. The government encourages people to get into this retirement programs because they want everyone to invest in their future. They know that we're all not going to be able to live only on Social Security, so they encourage that. And with that, I want to say thank you and hand it over to
I'm here.
Andrew
Jenny.
or to Jenny.
Yeah.
I'm not sure who I'm going to hand things over
Yes,
to.
absolutely. Thank you. So we have had so many great questions in the chat, and I just want to say, so first of all, thank you, Orumé and Shaneque. You've been amazing. And thank you for all of the fantastic questions. I'll let Andrew talk about this more in a little bit in just a moment here, but do be mindful that PACE does have this ongoing partnership with the NYSBDC Association. They do great work together, and there are multiple offerings coming up throughout the year with that partnership, and that can give you an opportunity to find out some more details about some of these things that you have questions with. And so get in touch with PACE and they can help direct you to resources and other options that will be coming up throughout the year. And so in just a moment, when we do shut down, I'll turn this over to Andrew, but when we do shut down, there is a brief survey. If you are able to fill that out, we always appreciate getting your feedback. So Andrew, go ahead and close us out here.
Great. Thanks, Jenny, and Orumé and Shaneque. Thanks so much. There was so much really valuable material there. I know there were some questions that are still remaining, and we'll do our very best to try and help address those. So first off, I just wanted to reiterate, I guess, our contact info, and I'll put it back in the chat, or Jenny or Greg, if you can, I guess, sbdc@pace.edu. That's our main email address. And I guess if you have remaining questions or things that we can help with. I did see that we have colleagues and friends and business owners from throughout the state joining us today. So PACE, again, is one of 20 SBDC centers located throughout New York State. So if you contact us, but you're in another part of the state, we can certainly connect you with our colleagues there as well for direct support and assistance. There are some things that we as business advisors and centers can do. What we can't do is provide direct accounting assistance. So that's why we really value the partnership with the State Society of CPAs and the work that folks such as Orumé and Shaneque can be able to support our small business clients. So it's really, really helpful. We have been able to offer some clinics where we've been able to connect Orumé and some of our other friends and colleagues at the society for one-on-one sessions with small business owners. So we've done a couple of those. Historically, they've been really well attended and really well received. As we're starting to approach tax season now, my expectation is we're probably not going to be able to get that in before the tax bell rings. But if there are specific things that you're trying to tackle, it's always good to kind of know what those questions are and see where we can be of help, either in the short term or in the medium term. My colleague Rick Hollander has been amazing about managing these efforts and these inquiries, so he can be really a solid kind of point of contact for you as we help, kind of look through the range of really, detailed and very, very spot on kind of questions that you all have posted. So we look forward to being a support and resource for you all going forward, and appreciate you being part of this today.
Thank you all.
Thank you so much, everyone. And yes, you will get a recording and a copy of the PDF, the slides, link to that PDF. So look for that in your inbox in the next day or two. Have a lovely rest of your day, everyone. Bye-bye.
Bye.